Hi everyone, welcome to the latest Facts versus Feelings, Take 5, coming to you live from Omaha. And where are we exactly, Sonu?
And we're together because we're not on split screens this time.
Yeah, there's nothing here between us. We are next to each other.
And we're edging closer, which is the theme of what we're going to talk about. But we are in Omaha at Carson headquarters on the 6th floor. This is our, I don't know, what do you call it, a lounge space? Nelly's? It's a lounge. Yeah. Nelly is Ron Carson, our founder's, dog, pet. So that's where we are right now, and we're going to talk our MidYear Outlook.
Yeah, we've officially released our MidYear Outlook. As a lot of you might remember, 6 months ago, we talked about some of these things. We said no recession. We said stocks might do a lot better than people think. Here we are at the midway point, Sonu. We're having one of the best years ever for stocks. We said bonds would do okay. Those are kind of the big things. When you think about it, though, so stocks gained almost 16% this year so far. I mean, in a quick version, why? Why in the world did that happen? When everybody told us, Sonu, it was a bear market and recession coming. Then we'll give our view of the rest of the world.
Except us.
That's true.
And I should say a lot of thanks to your research is around momentum and all that. We said at the beginning of the year that stocks could gain 12 to 15%. Now we are at 17%. Look, momentum begets momentum, and we haven't had a recession. I think it's as simple as that. That's why investors have liked to buy stocks this year.
Yeah, there's so much negativity out there, and you've had a lot of good views. The economy's stronger than people think. The consumer's stronger. Housing coming back. Manufacturing coming back. Yep. Let's talk about the Fed for a minute, because the Fed's a big part of it. The Fed hiked a lot, but they're almost done, right?
The Fed should be close to getting done. And look, last year, all of us are talking about how high will they take rates, right? From 0 to 5, that's where they went. Now we're still talking about, will they go up another, maybe to 5.25, 5.5? I don't think it matters that much within the, when you think about it, going from 0 to 5 is a big deal. Going from 5 to 5.5 even is probably not as much of a deal. The question is how long will they keep rates that high? Right, and we think they'll keep rates high because the economy is strong. It's really as simple as that.
Yeah, exactly. We do call this Carson's Take 5 for a reason. We try to go about 5 minutes. We're about halfway done approximately. Let's talk about our mid-year outlook, where we see things. We've upgraded our view on equities to up 21 to 25% for the year, which again, up 17% at the midway point. So that's a solid gain, and that would put us close to all-time highs, which at a year ago, or at the start of this year, would have been crazy to say, but we think that's possible. Bonds, we think will be around 4 to 5% for the year, which is okay, but we remain overweight equities. Now, Sonu, as we look for the rest of this year, how should someone potentially invest if you're looking specifically at equities here, you think?
I think you kind of said it, right? We're overweight equities. And look, a lot of it was based on the fact that the economy will not go into recession. And I think if anything, if conditions are better now than they were back in December. I think the risk of a recession was higher in December, but fast forward 6 months, the economy has created about 1.7 million jobs. Yeah. The unemployment rate is at 3.6%. More people are working, more prime age workers between 25 to the age of 54. More prime age workers are now working than they have been over the last 2 decades, right? So all of that is positive. All of that is translating to more incomes in the economy. That's translating into consumption. Guess what the economy is made up of, Ryan? Consumption. It's 70% consumption.
A lot of consumers out there spending. If you're confident you're going to spend, you think about it, technology communications had a great first half of the year, no question about it. But we started to see, honestly, since June started, broadening out. Industrial, small caps, mid caps, even financial is starting to do a little bit better here. Consumer discretionary has done great. The bottom line, so one of our big themes second half of this year, stocks can keep going up, but we think it's going to broaden out. It's not just going to be technology leading the charge like it had been. Let's talk about bonds just for a minute. Bonds are up about 2% at the middle of the year. That's kind of halfway where we were. Again, we're underweight bonds, but it makes sense to have some bonds in a portfolio, right?
You always want diversification. We found out last year, that was why last year was so abnormal. Stocks went down, which you kind of expect. That happens. But bonds went down too. You don't expect that, right? You expect bonds to zig when stocks are zagging. The good news is this year they've diversified, right? You had the big Silicon Valley Bank crisis in March. Stocks went down, bonds went up. That's that correlation, that negative correlation is what you want to see. That's a benefit of diversification. That's a good sign. Another sign that, we are getting back to normal.
Exactly. Let's just wrap it up. No recession. We don't see a recession in the second half of this year. We see stocks continue to do well, potentially making all-time highs, and bonds will probably underperform stocks. But hey, you'll get some little bit of gains from bonds as well. So with all that, his latest
Take five.
Yeah, well, I was going to say Carson take five.
Carson's
but it's actually
take five.
facts versus feelings take five.
Five.
We'll see everybody soon. Take care. Thank you.